All right, all right. Hello, everyone, and welcome to the Dividend Power Hour. It's good to see everyone in attendance. Who's out there right now? Let me know who's watching. Where are you watching from? What'd you buy this week? Did you guys buy any stocks in the past week since we met last Wednesday? We have the stock market almost reaching that 5,000 mark, so we're getting back towards all-time highs on a regular basis again. So you want to be mindful of that. But what are we out there buying? Did you buy something? Maybe you sold something. Did some options trading myself this week. Haven't really bought anything. Was really hoping that Disney would come down, but Disney actually had a good week, or a good day, I should say, today with all the announcements that they had, along with their earnings. So a lot of fun things going on at Disney. We have a jam-packed session today, though, here on the Dividend Power Hour, going through a lot of stuff. So if you're out there, let me know who's watching. I see Matthew is in here. I see Keeb is in here. BDCs, baby, let's roll. He's getting his BDC stuff going. No buys for Matthew this week. Good to see you, Matthew. Who else is out there tuning into the Dividend Power Hour today? Again, like I mentioned, a jam-packed session where we're going to be going through a lot of recent earnings reports and also be going through my top 10 holdings that I have. So a portfolio review here, just of my top 10 positions. So wow, we got a lot of these coming in right away. So we got no flooding in Temecula, so Kristen is safe. Yeah, I'm here in Southern California, folks, and it has rained for pretty much 4 days straight. Nothing like I've seen it in quite some time here. So we got Trinidad in the Caribbean. Nice, Joshua, great to have you. The Dividend Investor, CPA, is back in the house. Good to see you, my friend. ADC, excellent REIT, Agree Realty. John, good to see you. We got Graham in the house, bought some Google. Okay, I like that. Graham's gonna like my top position, but I have a feeling he already knows what it is because he is a member at our Investors Edge there. So he's got a good idea on what my entire portfolio looks like, in fact. So Stuart is sitting on the mountaintop buying some Southern, some SoFi, some NU, and some Vici. Nice. John, good to see you. No buys for the Dividend Investor, just saving up some cash and waiting patiently. I feel you there. I have a good size cash position right now, just waiting for that opportunity. But this is why I usually say it's good to always at least stay invested. Don't sell everything and try and time the market that way. There's areas where you can trim some positions to raise those cash levels, and always have cash levels available for opportunities. For me, I got the question last night. Hopefully a lot of you were able to join my free webinar I put on yesterday, and we talked about 2024 investing strategy, went through a recap of 2023, and just looked at stocks that I'm looking at, as well as we also looked at these top 10 holdings here, in addition to a lot of other fun stuff as well. So we got Michael, we got Maryball, we got Robert. Greetings from the home of the 13-second quarterback. We will see if he does it again on Sunday. This is going to be the first year in probably 2 decades that I won't be watching the Super Bowl. I might be, tuning in every once in a while, but I will be on the slopes up in the mountains taking the kids skiing. What else we got going here? Kenny's watching from Chicago, bought some more shares of McDonald's. We're going to take a look at McDonald's today. They were down about 3 to 4% last week. Troy, what do you think about 3M? 3M's one of those ones that's just been stuck in a rut. I'm glad they've kind of progressed through a lot of these, not saying all of them, but a lot of these legal issues that have really been holding them back. Just trying to see what is the catalyst higher. They have great products they're going to sell, but is there a big growth driver that's going to move them forward here? I'm still looking at it. So 3M, not one I'm saying it's a sell, but certainly not one I'm saying is I want to buy right now. So John, Vici. So John, if this is your first time joining the Dividend Power Hour, welcome. Vici is actually my largest REIT holding in my entire portfolio here. And you may even see it in the top 10 holdings we're going to look at here in a little bit here, but don't want to completely spoil all of that right out of the gate. Linda's tuning in from Louisville, Kentucky. Beautiful. Robbie bought some PFLT. We got another Vici buy here. What do we got, Joshua? I bought all the Magnificent 7 over the last 2 weeks. Going to buy more post-earnings. Testing a Mag 7 only portfolio, up 4% year to date. Wow. I'll have to duck out, but I can't remember if you save these live shows to your channel. Yep, Dividend Investor. These are all saved under that live section. Once you're on my channel on YouTube, you can watch the replay there. So thanks for stopping by, and good seeing you again. All right, what else we buy here? Trevon bought some ED and some Apple. I don't know what that means. I got some VOO like I do every week. There you go. Just stick with what works, right? Why not? D from Dallas. Medical Properties Trust. Okay. You're going out on a limb there. Hopefully you didn't watch my one of my recent video on some dividend stocks I'm looking to avoid. Long as you know the risks. That's all what I always say. How are you, Mr. Mark? Watching from San Francisco. What do you think of Mort? Good to see you as well. Let me take a look real quick. I'm going to start off by saying I'm not familiar with it, or I haven't been looking at it. So mortgage REITs, I'm not big on mortgage REITs at all, so that's going to be a no-go for me there on Mort. A lot of volatility, a lot of risk that's baked into that there. So no-go on Mort for me. Columbia, John Alexander there. Nice. Great to have you. Any thought on the infamous MPW? Again, watch that latest video of my 3 dividend stocks to avoid, and I give plenty of reasons there on why I don't like MPW. You got plenty of comments in that video saying, "Man, you really don't like MPW." And it's not like I lost money on it. I actually made money, believe it or not, on MPW, selling it when I did a few years back. Thank goodness. So check that one out. Sounds good. Thanks, Mark. Hope you all have a great session tonight. Remember, everyone stay invested and stay motivated. Great advice there. All right. So as I mentioned, we have a jam-packed session today. Have a lot to go through, including my top 10 holdings we're going to look at. So without further ado, let's get rolling on that right now. So let's begin. If you guys are frequent this Dividend Power Hour, this slide probably isn't all that new to you because we look at it every week. We like to look at where is the economy, where's the market right now. So here's our markets update. As you can see right now, the Dow Jones is up 2.6% to start the year. And we got the S&P 500 up almost 4%, and NASDAQ still leading the way. So we have the same exact, we started fresh in 2024, clean slate. NASDAQ kept the momentum and is still the leader out of the gate here of the big 3 indexes that we track. We got NASDAQ, S&P 500 in second, followed by the Dow Jones. And the Russell 2000 is still struggling out of the gate. So these are the small caps here, down about 2% last week, now down almost 4%, approaching 4% here to start the year. So still struggling out of the gate there. In terms of valuation, analysts are still looking for EPS for the S&P 500 as a whole of 20 times. So EPS of 20, or their current EPS puts them at a 20 times multiple. Over the last 10 years, you can see here that the S&P 500 usually trades around 17.5 times. So we are a little bit elevated right now. So again, as a reminder, how can this valuation metric get better? S&P 500 comes down and EPS stays the same. That's one way. Or the other way is the S&P 500 can keep climbing, but earnings need to catch up because that's the second part of the equation. Price divided by earnings. So again, this is just one metric. You never want to look to whether to buy a stock, ETF, whatever it may be, based on one metric alone. This is something that we hone in on and focus primarily on within the investing accelerator course I do, where I work with folks, individuals, one-on-one, put together an investing plan to build a portfolio for yourself, but teach you how to analyze stocks. Is this stock a good buy, a good sell? Is it a safe stock? Is it a risky stock? We look at the balance sheet, income statement, cash flow, all of that stuff within that. So if you want to check that out, you can find more information down below. So now let's move on to interest rates. Interest rates moved a little bit higher since we last met last Wednesday. We're up by 4.1% on the 10-year, and we got a 4.4%, 4.5% if we want to round up on the 2-year there. So we creeped up a little bit higher after a few weeks of that pulling back. Still in the midst of earnings season. We've passed kind of the prime time with those big time technology companies that were reporting earnings. But now we have CAT that reported, and boom, it hit all-time highs. We had McDonald's that actually came back. We had Simon Property Group, Disney, PayPal announced today. So we still have a slew of large companies that are still reporting this week. So there's a lot going on. We're still in the thick of earnings season. So in terms of jobs, we got the jobs report recently on the January. So the month of January came out, and that was on fire there on Friday. There's some things that we're going to talk about here, though, that we do want to watch out for. There could be some cracks in the jobs market moving forward, something that we just want to keep our eye on pretty closely here moving forward. And housing data, we saw a mortgage rates came down a bit. We were in the 6.5, 6.75 range for the 30-year last time we met. We've creeped back up to 7% there. So we saw a little bit of a pullback, and then boom, it jumped back up there pretty quickly. So we're back at 7% right now, which we have seen, applications come down more. Some bidding still going on when we had the rates come down. So we'll see if that kind of subsidizes across the board or not. So a lot going on across the market here. Here's our fear and greed index that we look at every single week. Last week we were in the middle of the greed section. Now we've moved back to extreme greed there. So as an investor, if you have some money set aside and you're looking to put that money to work, we probably want to think about some things here. Look at valuations first and foremost, a little bit elevated. Things are looking stretched here. People are just buying blindly, and that's the stuff that leads us into this extreme greed level, which tends to coincide with maybe a bit of a pullback. We'll have to see. And then earnings season is underway here. So here's a look at the list of companies, notable companies that are reporting earnings this week. We had Caterpillar, we had McDonald's, Simon Property Group, Eli Lilly, Spotify had a great report there, Ford, Uber, CVS. I haven't looked at the CVS one. I need to look at that one to see how that one does, but I'm pretty much completely out of that position there. And then we got a firm coming tomorrow. We had Disney today with PayPal. So still a number of companies, not the big mega tech that we saw in the last couple of weeks, but still some large notable companies there that we're going to be looking at. So let's take a look and see what. Number one, I want to pose a question back out to you guys right now. We're right at S&P 500, 5,000. We'll probably likely touch it tomorrow or go blow right through it. But after that, you usually get to these periods where, big numbers, big round numbers are a magnet for prices to get to. But usually after we get them, we usually see a bit of a pullback. Is that going to start the pullback? It's going to be anyone's guesses. I'm going to pose that question back to you guys out here. Do you guys believe that, okay, if we hit S&P, let's just say we're going to hit S&P 5,000 this week. Do you believe in the next, call it 30 days, that we will be higher or lower than S&P 5,000? Do you think we'll be 5,100, or do you think it's more likely that we're going to be at 4,900, 4,800, whatever the pullback that you believe is going to happen there, 4,950, whatever it is? Let me see. Do you guys think we are going to be at above or below where we're at this week? Let me know down in the comment section below there. Above or below? We're at S&P 5,000 right now. Do you think we're going to be above or below? So Matthew's going to say lower. So we're kind of just going to be right in the middle of where we're at right now, just a bit lower. Teresa is saying above. So this momentum is going to continue. And whoever has said that for the past weeks, months, year, pretty much has been correct. So, nothing's stopping us now. What can stop us? What is there to stop us right now is kind of the question. Eric thinks we're going to be flat. Olivia thinks we're going to be below. Legendary thinks we're going to be below. Christian is below. Michael, by the end of the year, definitely below. There you go, Jim. Don't care. My dividends keep paying. There you go. As long as you're investing in high quality blue chip dividend paying stocks, regardless of whether the stock goes up or down in the short term. Of course, we always want it to go up because it's growing our portfolio as a whole. But especially, if you're in that accumulation phase, you kind of want companies to kind of stay flat or come back a little bit, because it's not like, we have $500,000 just right out of the gate to invest. Most folks have to build up their portfolio over time. And when stocks stay stagnant, that gives you more time to increase your shares there. JC, good to see you. JC's saying below. Graham is saying lower. Lots of chop until rates are cut. Amen, Jim. There you go. Some more dividend investors. So I love it there. All right. Well, let's jump in and take a look at some earnings that we saw here. So let me open up the old iPad here. I'll share this with you guys here. So hopefully you can see my screen. All right, so let's begin. Let me scroll over here and let's start with let's look at the jobs report first. So this is something that I wanted to look at with you guys here. I'm going to scoot this over in the side here so it's a little bit closer to me. All right, so the jobs report came out last Friday, and as you can see here on the list, jobs came in really hot, well above expectations there in terms of what analysts were looking for. 353,000 jobs added in the month of January. That was phenomenal from that standpoint there. Unemployment rate, that's something that we're going to continue to watch. We've got a lot of reports lately on what? Layoffs, some layoffs coming there. So unemployment currently sits at 3.7%. So if we go down here and you know, you could see, you'd read all about this and bore yourself to death here and see where were the jobs added. But let's take some of the things I like to look at. Labor participation rate, 62.5%, unchanged from the month prior there. So that was fine there. Nothing to whine about, complain about. It was just solid. So there's our 353 again. Let's keep going down here, and I want to show you guys something else. So let's look at average hourly earnings. We want folks, obviously, to keep making more money. That usually coincides with people can have more money to spend, which then coincides with businesses doing well. Because if businesses have more money to spend, consumers have more money to spend, we can usually keep that economy going from that standpoint there. So average hourly earnings for all employees. We saw, where'd that go? We saw that rise by 19 cents, so 0.6% in terms of a jump there. So they did go up, which was good. Over the past 12 months, average hourly earnings increased by 4.5%. So that was very solid there in terms of a strong report. A lot of jobs added, also wages going up as well. What else are we looking at here? This is what I want to hone in on, and this is where when I was reading this, and I don't go through the whole report because you could see it's just pretty boring from that. It can be boring from that standpoint there. But the thing to look at here, if my iPad would just chill out, is the average work week for all employees. What do you see there? Decreased by 0.2 hours to 34.1 in January for private non-farm. In manufacturing, unchanged. The average work week overall decreased by 0.2 hours. So in this incident right here, what we're talking about is the fact that people are working less than they were. So we're not necessarily getting layoffs, but this is usually what companies do first. We're starting to struggle a little bit. So what do? We don't just, companies don't want to just go and say, nope, let's just start layoffs, mass layoffs, because we went through a period in which we saw labor shortages from many different industries that were out there. So we don't want to repeat that. So what can we do? We can lower the work week. Okay, maybe you don't work 5 days. Let's bring it down to 4 days, or 4 days down to 3 days, whatever it may be, if you're an average hourly worker from that standpoint. Let's see if we can lower the hours and just hang on enough and hope the economy or our business turns around. If it doesn't, after that point, what do we got to do? Then we have to go to layoffs. So although our average wages are up, people are getting jobs, but at the same time, people that are working less, average hourly. So again, if you're an hourly employee, you don't get paid more if you're working less. So from that standpoint, that was a little bit of a crack, maybe just something small to kind of keep an eye on. We've heard a lot more reports on layoffs from numerous companies in the past just few weeks alone. So that'll be something we have tomorrow just to keep an eye on every single week. Look at that unemployment. It comes out every week. Look at that unemployment update. Where's unemployment rate? What's the jobless claims? So we have jobless claims. I believe it comes out tomorrow, if I'm not mistaken, from that standpoint there. So that was something we wanted to go over there. Now let's move on to some more exciting stuff. And let's begin with Caterpillar. Does anyone out there own any Caterpillar? Caterpillar had a good week here. If we look at the past 5 days, you could see that Caterpillar was up 5%, over 5% in the past 5 days alone. A lot of that coming from earnings. You can see that big old spike that we saw there right when they reported their earnings recently. So let's take a closer look at those earnings. So if we look here, we could see that the Q4 non-GAAP EPS came in at $5.23. That was 0.48 above average analyst estimates. So they blew those out of the water there. Revenues missed by just $30 million. So they were pretty much in line with what analysts were looking for. Revenues increased 3% overall year over year. So the industrial makers continue, heavy machinery, large tractors and stuff like that is what Caterpillar makes there. And those are continuing to sell. Strong operating cash flow at $12.9 billion, end of the year with $7 billion in enterprise cash. And they're using that cash to give back to their shareholders in the tune of $7.5 billion between both dividends and share buybacks. So that's pretty awesome there from that standpoint. Caterpillar is certainly firing on all cylinders right now. So let's look at the results a little bit closer. You can see the stock rose, but this is the chart that I wanted to kind of take a closer look at. The light blue is what they actually reported. The dark blue, or I don't know if that's black or dark blue, that's what analysts were expecting. And then the orange is going to be the difference. The trend that you see here is not only are we trending higher every quarter, that's a great sign, but we're trending higher and above analyst estimates. So analysts are expecting here, we are booking up here. So they're beating analyst estimates every single time except for that Q4 2022 quarter was the only time that analyst estimates were above where Caterpillar came in there. So is that management doing a good job of showing guidance just enough, but it's a level that they can surpass? Or are they truly giving true guidance and just outperforming? That's the question you got to ask as an investor there. So anyone out there with any Caterpillar there? Doesn't look like Matthew has any Caterpillar. Billy said, don't care as long as the dividends keep coming in. Referring to Jim C's comment above. Love that. All right. How about McDonald's? Any McDonald's fans out there? McDonald's fans from the food, or McDonald's shareholders? Anyone out there own any McDonald's? I remember someone mentioned that they were buying some McDonald's last week on the dip here. So they reported earnings recently, and the stock actually pulled back a bit here. So you could see over the past month where we have McDonald's, and here it is over the past 5 days. So you can see right around that February 5th time is when McDonald's obviously reported earnings. They've gained back probably half of that so far, but that's where they're at right now. So let's take a closer look at McDonald's and see where we're at. So McDonald's reported non-GAAP. Remember, that's what we want to focus on. That's that adjusted GAAP earnings, comparing apples to apples. If you had one big event that happened this year, that's going to be excluded from it because that same event isn't part of normal operations and wasn't anything part of last year as well, or vice versa. We want to keep apples to apples. That's why I focus on non-GAAP, otherwise known as adjusted EPS when we're looking there. So, all right, what do we got? John's got some McDonald's, just started in it. Kenny, both food and shares of McDonald's. There you go. SCM Invest. I haven't willingly eaten McDonald's since 2005. I might be right there with you. There may have been, I want to say probably one time in the last 15 years that I may have stopped at a McDonald's it being the only option on a long drive and got some, I think my wife and I split some chicken nuggets or something like that. So, all right, let's look at these results here for McDonald's and see how are they doing. So this was their Q4. So they gave us their full year and their quarterly results here. We got Q4 EPS of $2.95, which beat by 12 cents. So we got a small beat there. However, revenues missed by $40 million. Analysts were expecting $6.8 billion in terms of revenues, or sorry, 6.41. They missed by $40 million. But however, revenues were up 8.1% year over year. So nothing to cry wolf about. But again, with these companies, whether it's Starbucks, whether it's Target, whether it's Walmart, whether it's McDonald's, these companies, the main metric that you want to look at first and foremost, I shouldn't say the main one, but one of the key ones that you want to look at is comparable same store sales, comp sales, because a lot of these companies are opening a bunch of new stores. So if we had 100 stores last year and we have 125 stores this year, well, then naturally, if we just looked at revenues would be higher. Why are they higher? Well, we added 25 new stores, so we had a lot more revenues coming in. However, when you look at comp sales, comparable or same store sales, same technique or metric there, it takes how many stores did we have last year that were open for at least 12 months? Compare that to this year's bucket of stores that have been open at least 12 months. So none of the newly added in the last 12 month stores are going to be included in this bucket. So it's a little bit more apples to apples from that standpoint there. So global, this is McDonald's, all of their stores combined. Comp sales came in at 3.4%. All U.S. segments, stores came in at 4.3% higher. That's solid there. International, 4.4%. So again, I always like to say McDonald's is actually a real estate company. They franchise out a lot of these stores, not all of them. They franchise out a lot of these stores here and really just collect rent on the buildings and on the land and stuff that they own from the franchise owners there. So obviously they want McDonald's to do well. But when it comes down to it, the core of their business is McDonald's is a real estate company, not a Big Mac company. So any comments on McDonald's? I know someone Who was it that bought the dip on McDonald's there? Arnett, I'm new to the group. So you do live weekly. Yep, every week we do. This is the Dividend Power Hour. We just kind of go through the market as a whole, bounce ideas. We're just a close-knit community here, a growing community of investors where, I kind of give my insights on what I'm seeing in the market, the economy overall, and folks comment in and we just bounce ideas off each other. We all have one goal in common here. It's to build wealth. Whether you're a dividend investor or not, you can come here and enjoy it and hang out with us for an hour to kind of talk stock. So great to have you. Hope you enjoy it there. Question, where can you find out if a stock paid monthly, quarterly, or annually? Well, good question. Let's do it right now. So hopefully you can see my screen here. We're going to keep looking at McDonald's. This is Seeking Alpha that I'm using. So this example here is Seeking Alpha. It's a free one. They have a paid version if you want to as well, but you can click on the dividends tab there. You could scroll down to see more about the dividend. I'll give you the dividend yield. You could see what's their payout ratio, their 5-year growth rate. I usually like to invest in companies that are dividend growth stocks, so growing at a 10% clip or more. This one's close at about 8.5. McDonald's is near dividend aristocrat status, meaning they have increased their dividend for nearly 25 consecutive years. Every single year for the past 22 years, McDonald's has increased their dividend. But then right under that is the latest dividend that's been announced. And you can see that how much for that dividend they're paying. And to the far right, you could see the dividend frequency. So this dividend here is paid on a quarterly basis. If we go to something like, let's go to Realty Income. If we go to Realty Income, stay on the dividends tab there, we go to the bottom, you can see that that dividend is paid on a monthly basis there. So hopefully that's helpful answering where you can find more information about that there. But good question. All right, let's keep honing in on McDonald's here to see what was going on. So we saw comp sales were up 3.4%. U.S. comp sales were up 4.3%, but analysts were looking for 4.5%. Part of the reason for the drawdown in the stock price after reporting earnings there. Comp sales were noted to have benefited from strong average check. So those are some still things that we like to look at. Same thing with Starbucks. What was the average ticket price and what was the number of transactions? Because we can lift prices and have less people come in and still try and, maybe our revenue doesn't grow, but we want to see both. We want to be able to have the power to increase prices and still have traffic increase year over year. So that's something that Starbucks is doing right now, at least here in the U.S. Definitely not in China, but here in the U.S. at a solid clip. So they just pushed through, at least here in Southern California. I don't know if it was global, but here in Southern California, when I ordered my cold brew, I saw a 25-cent increase in the past few weeks here. International license markets for McDonald's, 0.7% comp sale increase. That was a big miss there. Analysts were looking for 5.1%. So have to see what's going on there. Consolidated operating income increased 8%. Operating income is something that a core piece of my analysis when looking at it there. Full year free cash flow conversion rate of around 90%. Operating margins expected to land in mid 40% moving forward. Expects to open about 2,100 restaurants globally here. Wow, that is fast. That is a lot of arches going up here across the globe here. So that's a look at McDonald's. Let's keep rolling here. Take a look at Simon Property Group. You guys know that I'm a big fan of REITs. Roughly 15% or so of my entire portfolio is made up of REITs or real estate investment trust. Great way to diversify your portfolio, gain some real estate exposure here. If there's one thing that's been proven over time, it's that real estate has been an appreciating asset. It's not a depreciating asset. Cars, those are depreciating assets. Most cars, 99% of most cars that are out there are depreciating assets. Real estate has been proven to be an appreciating asset. Computer, hardware, equipment, all of that stuff just doesn't have a life that lasts more than 5 or 10 years for most things. Real estate does, and that's why it has appreciation in it. So Simon Property Group, for those of you unaware, is the largest mall landlord in the U.S. or in the world, really. So they have some fantastic malls, outlets, open, indoor, whatever it may be. And during the pandemic, malls obviously got hit hard. A lot of malls started shutting down even before the pandemic. And a lot of that was C and D rated malls. So when it comes to rating malls, a lot of it is based on the retail sales per square foot. So the tenants that you have are usually retail. A lot of them are retailers. They lease a space. What is their sales per square foot from that actual company there? And then whatever it is as a portfolio as a whole, That's how they go through and classify whether you have an A-rated portfolio, an A plus, a B-rated portfolio, a C, D, whatever it may be. So a lot of those C and D-rated malls are the ones that we heard about that were closing their doors because of, number one, low occupancy, low traffic, couldn't lease people. It was just a ghost town there. Not the case when we're looking at Simon Property Group. So Simon Property Group here up 4.4% over the past 5 days there. So some pretty solid earnings. So let's take a look at them. Again, we don't look at EPS when we're focusing on REITs here, because the thing that's in EPS is depreciation. And we don't want to depreciate our assets over time. That's an accounting thing. If you buy a $50,000 car and it lasts for 5 years, you need to depreciate $10,000 every year. It's writing down the value on your balance sheet. That car is no longer worth 50. We need to depreciate it down to 40. So we bring it down $10,000. Real estate appreciates in terms of value there. So you still have to do it from an accounting perspective, but we don't want to look at that. So that's why we skip looking at EPS. And instead, when evaluating REITs, you want to look at FFO or AFFO. So Simon Property Group reported Q4 FFO of $3.69, which beat pretty handily by 36 cents there in terms of, what is that, 10% beat there for SPG. Revenue was up 9.3% year over year, and they beat by $160 million there. So a good beat on both the top and bottom line there. One reason the stock is up 4.5%. Net income came in at about $750 million there. Here's what I like to look at, though. Domestic NOI increased by 7.3%. Portfolio NOI increased by 7.2% compared to the prior year there. And then they gave out some guidance here that came in a little bit below analyst expectations. You know, analysts were looking for $12.20. The high end of the range was $12.10. So a little bit shy there. That was a little bit disappointing from that standpoint there. So let's take a closer look here at SPG. So we already talked about the FFO. Let's take a look at occupancy. So occupancy here, let's do this really quick so that we can see what we're talking about. All right, so here's our occupancy for U.S. malls, 95.8%. So they don't have a problem bringing in tenants into their malls. Malls are dead. Not the case when you're looking at Simon Property Group. It was 95.2% at September there. Base minimum rent per square foot, $56.13. That was compared to $56.41. So minimum rent per square foot there's a little bit down from the prior quarter. Let's see where. I want to show you guys that how we rate them. And I think I had it up here already. There we go. So let's take a look at retail sales per square foot to see what type of mall are we talking about here. Remember, I told you that they're an A-rated mall. Okay, show me that, Mark. You got it. No problem. Let's see if we can find it real quick. Here's our NOI up 7.3%. We already saw our occupancy was up. New rents going in at $74 per square foot. And boom, here we go. Reported retail sales. This is the section you want to look at. All right there. $743 for malls and outlets combined, and $677 through the mills. So that's another section of type of malls that they have there. They did sell a portion of their ABG for gross proceeds of $300. So these are the numbers that I like to, that's how you kind of get rated based on a mall overall. Are you at $500? Are you at $700? What is it based on retail sales per square foot from that standpoint? And Simon Property Group going into the pandemic was A-rated. Simon Property Group coming out of the pandemic is still an A-rated mall. That tells you the strength and the quality of this portfolio overall here. But again, you obviously need retailers to remain strong. You need the economy and consumers to have money to go spend. Otherwise, Simon Property Group could have some heavy pressure on it from that standpoint there. So it's all relative when we're talking about things here. All right. Does anyone own any Simon Property Group out there? Do we have any REIT fans at all? Let me catch up here on if you guys have any questions. OGC with a 6.7% yield has been very good stock for me in 2024. It's a nice size yield right there. Kelly, good to see you. All is good here. Thanks for subscribing there, Will. Appreciate that. All right, let's continue on now. What do we want to look at now? Let's close some of these windows here. We got too many of them open. Let's take a look at Disney. So Disney is fresh off the press here. You can see that Disney is up over 6% after hours. So tomorrow's expected to be a very solid day for Disney. And the House of Mouse has struggled mightily here. If we go out on the 5-year chart here, you can see that the stock touched back in 2021, touched over $200 per share. It fell all the way back down to in the 80s, not all that too long ago. And now we're hovering back right above $100 per share. So we ended today at $99, but after hours has the stock trading about 105 and change there. So tomorrow's expected to be a great day when it comes to Disney. Any of you own Disney out there? That's one of my daughter's stocks in her portfolio. You know, I always say when it comes to kids, I try and invest in things that they can relate to. It helps them get a little bit more involved. So when we go to Disneyland, she goes, "Oh, Dad, I'm helping my stock." Yeah, you are. Let's just not do too much spending. We don't want to help it out too much. At least I don't. So, all right, let's take a look at the earnings call here. Up 7% post market here. Why? A lot of news has come out on Disney. Not only did they report earnings, but they had a bunch of other news that's come out. So they're teaming up here. Let me see if I have that up here. Here's the team up. So we have Disney, Fox, and Warner Sports all coming together to build a streaming app to where you can go and say that maybe you have cable TV, YouTube TV, whatever the case may be, but you're just a sports fan. Like, hey, I don't care about having all the news channels. I don't need HGTV. I don't need all of these other channels. I just really just want ESPN, my Fox for football, you know, whatever the case may be. Well, here's an option now. It's expected to be priced between $40 and $50 per month. Are they late to the game? You know, it's still, you know, if you're a football fan, you're missing CBS, so you kind of have to have Paramount and you have to have this. So we'll see if this, you know, takes off or not. They're trying to compete with the likes of Google TV and stuff like that. So that's to be seen when it comes to that. So let's go back, and that's just one thing that was announced yesterday. That's just one thing that's going on when it comes to Disney here. ESPN has been in a number of news and topics over the past, 6 months plus, maybe a year plus, in terms of, are we selling ESPN? Are we keeping ESPN and going all in on ESPN Plus? Well, what they're doing is they're building out a flagship ESPN digital offering that's expected to come out in fall of 2025. So that if you just want to watch sports that's across all ESPN, you can just have this one digital app and watch it from there. So I'm kind of trying to understand it a little bit more, because it seems like it potentially competes with the deal that you just did with Fox and Warner. They've only been announced 1 or 2 days, so it's not like it's not something they've thought about. So maybe I just don't understand it fully. I don't know what the case is there, but we'll have to see how those kind of play out there. But yes, Troy, the mouse is coming back. I'm here in the Southern California area, so we venture over to, whether we're in downtown Disney just going to get dinner, or we go into the parks or whatnot, and they've been crowded. I mean, there's just people walking out like it's Christmas. You know, the other day we were walking back to the car. 2 ladies just had 7 bags, both each in their hand. They had their cart filled with bag. I was like, did I miss a holiday or something like this? So people are out there spending. They love Disney. They have great assets. The Magic Key Passes went on sale last month, beginning of January, sold out in less than 8 hours. People are paying, $5,000 plus for the top one, for a family of 4, I should say. So those just whatever they raise their price to, they're unaffected from it. So parks are starting to come back. That's obviously a big component of them overall. Studio is still struggling. People aren't going out to the movies like they used to. Is that something that's going to come back? I'm not sure, because we've kind of got spoiled with folks just putting things straight to streaming, putting things on Disney Plus, putting things just on Paramount or Netflix, whatever it may be. And the other thing, since this is what, I don't know if we have any Taylor Swift fans I wouldn't imagine we have a ton of Taylor Swift fans on this YouTube live here, but look at this right here. The company is they secured exclusive rights to the concert film Taylor Swift, which I believe, not surprising, was the top grossing movie in the last year. It was just a remake of her concert. So not only did she make billions on her concert, she said, hey, just film it along the way. We'll create a film, make a couple more billion. Why not? So from a business standpoint, phenomenal there. So that was key there. So any Disney fans, out there? Do you have that in your portfolio at all? Would be curious to know there. So, all right. So now we got 15 minutes left. So let's go through my top holdings because I know that's what some of you have been waiting for patiently here is like, Mark, just show your holdings. You sit on there. This is the top holdings we're going to go through, and we are. I promise. Don't worry. We're going to get to that right now. Let me bring it up here. So let me begin by asking you guys, what is your top holding in your portfolio? Just the number one, the biggest weighting overall in your portfolio. What is number one? I would love to see that there. What do you got as number one in the portfolio? Bam. I'm new to the group and signed up for the Investor's Edge. Dean, awesome. Great to have you. Yeah, so for any of you that are interested in seeing my entire portfolio, we do monthly portfolio updates. Today, we actually just published our brand new top watch list stocks. So we do a list of 10 stocks that were a little write-up. You can see great graphics in there as well of the 10 stocks that are on our watch list. Each month, you're going to get that. You get a monthly portfolio update for both Chris and I, who both run the Investor's Edge there. You get a weekly stock deep dive on an individual stock. You get earnings recaps for all the stocks that we cover there. So it's just jam-packed with information that's delivered straight to your inbox there. You can sign up for pretty much $1 a day there. The link is down in the description below. We have a free version, which you don't get all that stuff. You get our weekly updates and stuff like that. Or you get the paid version, which comes with a lot of the stuff that I just mentioned there. So if you want to see and stay up with my entire portfolio, check out the Investor's Edge. I'll leave a link down in the description there. All right. So what are our top positions in our portfolio? Wow, let's see it here. I got to catch up. O and NNN. So 2 REITs there for Graham. SCHD for Rich. Amazon for Taylor. That's a good one to have there. Jim C, SCHD by far. Love it. It's a good one. John, SCHD. Love it. Legend, 3 SCHDs in a row. Teresa, triple Qs. Paul, NVIDIA. Paul, how long have you held NVIDIA? And I hope you say more than a year because that is going to be an awesome holding for you right there. AGNC. Again, D, I hope you didn't see my my stocks to avoid one at all. Christopher, PepsiCo. Another SCHD for Joe. SCHD for Paul. Dean got some Warren Buffett. Berkshire. Olivia, SCHD. Kristen, Chevron. Brian, Broadcom. Oh, I love that one. Matthew, the VIX. Anur, Qualcomm. Top holding for Bill is SCHD. 40% VU and 40% SCHD as the top positions there. John's. Jeffrey, O and MDY. We got Maine as a top one. Berkshire, SCHD is 27% of the portfolio. What day do you do these lives and times? We do these every Wednesday at 4 p.m. Pacific time, which is 7 p.m. Eastern time. JEPQ for John. And top holding for Troy is Berkshire. No dividend, lots of Apple. It's pretty much an ETF in a bundle there. So you got to trust Buffett with your money there. So I don't think there's too many better people that you can have running that than Warren Buffett and company. So, all right, let's take a look at my top 10 holdings here to close it out. So number one, you probably hear me say it a lot, is the fact that it's important to build a firm foundation for your portfolio. Anytime, whether you're new to investing, you've been investing for 5 years, make sure you have a core portfolio or a core position in your portfolio. For me, that's an S&P 500 index fund. It could be an ETF, could be an index fund. I just bought this years ago, and it happens to be an index fund. I also have SPY, so you can kind of blend those two together because they're both tracking the same exact thing. Just one is an ETF, the other is an index fund. Let's look at the next one. We got Vanguard Dividend Appreciation Index Fund. So this is VDADX, focused on more on dividend growth. So could be compared to a little bit of SCHD, a little bit of DGRO, a blend of those two put together there. Number 3, there it is. I know we have a lot of SCHD fans out there. And again, I think we're going to have if the market rallies this year, I think it's going to be broad, and I think SCHD is going to do just fine. It's accustomed to meeting or beating the S&P 500 when we get normal rallies. Last year wasn't a normal rally. Nvidia, a large mega cap stock, up 200+%, not realistic. Meta, another one, up 200%, not realistic. The laggard of the Magnificent Seven was up 48% to be exact. For Apple, those years are fantastic. Let's take them while we can, but it's not something we can, become accustomed to, obviously. So when things are broad and normal, I think SCHD is going to be just fine. But I will be curious to see if they increase their technology exposure here when they do their reconstitution in another month. And now we get into some individual stocks. So the rest of the way, if you guys joined the free webinar I had yesterday, these top 10 stocks are what I went through as well. So my top 10 holdings, but this is my number one individual company. I'm a dividend investor, but boom, Google does not pay a dividend there. I like that one a lot. I think they have a lot of room for growth with AI. The top two best search engines with Google search, as well as YouTube, which we're watching on this live show on right now. A lot of levers to pull. We got cloud, you got AI, you got search, advertising, whatever it may be. I love Alphabet and I love the management team there. Maybe they follow in Meta's footsteps, say in the next 5 years, and potentially pay a dividend down the road. Maybe. We can all have wishful thinking, right? Next is Microsoft. And this one actually wasn't because of how much I've invested. I've actually invested a lot of money into Alphabet. Microsoft, again, I told you I trimmed, but it actually grew into this position. It grew into a top 5 position, just of how much it's outperformed over the last few years here. So even though I've trimmed it, still in a top 5 spot there, but hasn't quite caught up to Alphabet. Next is Johnson & Johnson, one staple in terms of dividend investors there. Healthcare spun off their consumer health segment, which owned popular brands such as Band-Aid, Tylenol, Motrin, Johnson and Baby. What else they got there? The mouthwash one, Listerine. There we go. So spun that off, and now they're left with the pharmaceutical segment as well as their medtech segment, which is a lot faster growing there. Tons of a big time pipeline with the pharmaceuticals. Medical devices is an area that I think has a lot of growth. And in their latest earnings that we saw, did have a reasonable amount of growth there. Next in line is Lockheed Martin, so a large defense contractor there, fighter jets and things like that, with all the unrest going on across the pond here in not only Russia, Ukraine, in Israel. You got possible tensions with China in the U.S. Everyone over in Europe, pretty much everyone around the globe is looking to bolster their military. One reason you see Lockheed and other defense contractors with huge backlogs there. I mentioned this on the webinar yesterday, the fact that Lockheed has enough backlog that if they made no sales the rest of the year, they would still have stuff to work on into 2025 there. So a lot of headroom and growth ahead for Lockheed there. Next is Visa. And I like Lockheed. Lockheed had a bit of a pullback here. Earnings actually weren't that fantastic in their latest quarter there. So could be one to take a peek at. Next is Visa. People love swiping credit cards. We saw credit card debt at all-time highs recently, or still is from that standpoint there. Really just the middleman. Visa is utilized across the globe here. It's not just focused on the U.S., not just focused over in Europe or whatever it may be. Visa is accepted all over the globe. They don't have the same troubles as the likes of American Express, though, which is another quality card to look at. Next is AbbVie. This is one of my favorites, one of the ones that I've held the longest. Healthcare, pharmaceutical type company. For a while, had the top selling drug in Humira. I mean, they were the top selling drug by a mile. Patent protection expired at the beginning of 2023. So those sales came down as new generics came on that competed with the likes of Humira. But now they have some up and coming drugs, one being Rinvoq, the other being Skyrizi. These are the two that investors need to hone in on, because according to management, when you put these two together, it should far exceed that of Humira's best year. So there's a lot of growth packed into AbbVie, and I think investors have been paying attention because the stock's been moving in the right direction here. Plus, you get a 4% dividend, plus you get 10% dividend growth there. It kind of checks off all the boxes. And then number 10 here is Vici Properties. So I know a couple of you mentioned Vici there, my largest REIT holding. The largest landlord on the Las Vegas Strip, owns the likes of MGM Grand, Caesars Palace, the Mirage, Mandalay Bay, New York, Excalibur, Luxor, just a number of great assets there. And roughly only 50% of their portfolio is Vegas there. They have other properties all across the states here. So high quality company, high quality management, only been public for about a handful of years there. So you may or may not have heard of it. But Vici is a solid one there. So how much is too much Vici? Alejandro said, just started to buy Vici. Thank you, Mr. Mark. It really comes down to, I like to look at weighting. So my rule of thumb that I mentioned in my webinar yesterday is the fact that I don't like to exceed 8% for an individual stock in my portfolio. So if a stock grows because I just keep investing too much and all of a sudden I look up and it's 12% of my portfolio, not something I want to have that much exposure to. Or maybe it just grows into it because it outperforms. If in NVIDIA, I didn't put $1 into NVIDIA for a year and it went up 200%, it's likely going to climb the ladder board. If say it was in the leaderboard, it was in 10th, it could easily move up to a top 4, 3 position, whatever case may be, and it could go above 8%. One reason I would have to trim. So my rule of thumb is 8% in terms of individual stocks. Now, I don't stick to that when it comes to ETFs, have a lot more leeway, a lot safer when it comes to ETFs, a basket of stocks there with that. So any questions, thoughts on my top 10 holdings? How many of my top 10, how many do we share of these 10? You can lump in any of those S&P 500 funds that you have with my top one there, and maybe DGRO or something with the second one there. But in terms of the other ones, there's probably a lot of overlap between all of ours here. Would be curious to know how many of my top 10 do you have in your portfolio as well. SoCal train to Vegas should help Vici. When is that coming, Paul? Is that like a bullet train or something like that? A speed train or underground train? Is that the Boring Company with Elon? Like, I don't know if I've heard anything about a train to Vegas. I could take a train from here to Vegas and meet up with Ryan, my other dividend buddy on YouTube. All right, Dean, what do we got? Dropping in some change in EOPSF, which is a small Australian defense contractor with a decent backlog. Not familiar with it, but something I'll have to look into. So John has 7 overlap. Okay, nice. Do we have any more than 7? Kristen's got 5. We have an overlap of 5. DEA and PSTL make more money than Vici. Are you talking in terms of they pay a higher dividend? What are you referring to in terms of make more money? VDADX is new to me. Never heard of it. Looks great though. Yeah, I've had it for a while. I focus more on when I'm adding to it now. It's really going to be added more to SCHD, DGRO. I just like ETFs just because of the optionality with options, no pun intended. But that's a reason I'm building a position in SPY. I don't really add any more to my VFIAX position. I add when I'm adding S&P 500, I'm adding it to my SPY position. Paul A. So that train's going from Rancho Cucamonga to Vegas. Interesting. I used to live out in the Riverside area when I was going to college. So JC's got 7 positions overlap. Olivia with 8. There we go. Nice. Tanner Wilson, 5. Got the FXAI. I actually used to have that one. That's when I got out of it and said, I need to put more money into SPY. Same thing, different brokerage offering, but both tracking the S&P 500 and DGRO for top 2. Alex, only 1. All right, so then give me an idea on some of your top 10 then. Or is it more growth oriented maybe? Mentor, only 1 also. Same thing. What are some of your top? Be interested to know there. Yes, and dividend yield. Yeah, so when it comes to yields, not really. I'm looking more for quality and value. I never invest in a stock based on yield alone. You'll hear me say that a lot. You'll hear me tweet that a lot. So just be mindful of that. I haven't looked at DEA or I forget the other one you mentioned, PSTL, for a while. Rich Diaz, good to see you. SCHD and Vici. There we go. Paul A, I own most through VTI, and that's about as diversified as you can get for looking at U.S.-based companies. Arnett, this was a great meeting. I'll be back next Wednesday, 7 Pacific time. You got it, buddy. We'll see you next week. D's got 8. There we go. We have another 8 there. Awesome. SPY and VOO, which is better? That's really going to come down to you. They both track the S&P 500, so they generally should have the same exact overall return rate. Look at the expense fees. If you are interested in options, SPY is going to be the better bet for you. If options don't matter, go with the lower expense fee, which I believe is VOO. Legendary, SCHD and AbbVie just started positions in LMT and J&J. Thinking about Google. Nice. So that'd be 1, 2, 3, 4, 5 right there. Jim C. grew up in Riverside. Oregonian for many years now. Nice. Dean, I have the baby of SPY, SPLG. Okay. All right, Rich. What else we got? We got Realty Income. We got Coca-Cola, EXC, Kenvue. That, for those of you unaware, that's what Johnson & Johnson, when they spun off their consumer health segment, that became Kenvue, and then Peebo. All right, what do we got here? My favorite is REXR. That's California-based industrial REIT right there. That's a good one to look at, one I've actually looked at more recently. All right, Alex, what do we got? We got Abbott, which is where AbbVie was spun off from. Pfizer, so we got back-to-back healthcare. Portillo's, Starbucks, love that one. That one is just outside my top 10. So I want to say Starbucks might be 11th or 12th. So very easily could have been in there. Vici, same with Realty Income. That's around 11th or 12th. And you got Vici there. So solid list you got. All right, Mentor, we got BAM, Vici, CNR, and BCE are my biggest positions. 5 overlap here for Christopher. Is SPY great for SPY? SPY is just good in general. Brian's got 5. Jeff, 4 p.m. Pacific times on Wednesdays. Yep. 4 p.m. Pacific time on Wednesdays. I might have said it wrong there, so thanks for clarifying. I don't need our net showing up at the wrong day and wrong time and wondering where the heck the dividend power hour is. All right, Jay, what do we got? Just added recently to Visa and Google to my portfolio. Both continue to have great growth. Visa's been just rock solid lately. Google came down after, I bought a few shares after earnings when they dipped, but those are already positive now. So, all right, Bill, IVV, which is going to be SPY or VFIAX. So we got some overlap there. We got Google, UNH, solid. I have that one. SWKS, O, and Disney. Okay, Bill's going to be a happy Disney shareholder tomorrow. That one will be headed much higher than it is today and crossing over the $100 per share limit there. That is solid. My favorite now is AbbVie. It's killing it right now. It absolutely is. You are totally right there. Paul is got 3M on the watch. John Wayne with 7 overlap. Slim, good to see you. SPY and IWM, good options. And then Jeff Layton, FXAIX, which is our S&P 500, SCHD, Microsoft, Visa, AbbVie, and looking to add Johnson & Johnson on a dollar cost average. That's when JC picked up Google after earnings. Good timing there, JC. So awesome. Well, that was jam-packed. We went through a ton of earnings reports. We went through economics reports. We went through the jobs reports. We took a look at my top 10 holdings here. So this has just been a phenomenal time. And if you guys are interested in working with me one-on-one and taking your investing to the next level, understanding how to value stocks, how to read financial statements, how to put together, if you're brand new to investing, how to put together a strategy and an action plan to help build yourself a portfolio that reaches whatever your goal is in terms of dividend income, or you're a growth investor, then definitely consider signing up for my investing accelerator program. You work with me one-on-one. We would just meet once a week for roughly 60 minutes. If you sign up for the newsletter, the free version down there, you will be on our mailing list, and we'll send you information there where you have the opportunity to book 15 minutes with me to talk, get more information, to book a call. And then from there, you can sign up and we can get started there. So thank you guys for joining me this evening. It's been again, a jam-packed one. We went through a ton. It was interactive. That's the best part of these, is the interaction with all of these, seeing new faces, seeing old faces coming in, people that join it on a regular basis. So it's just always so much fun for me to chat with you guys every Wednesday. And with that being said, I will see you next Wednesday. If you haven't done so yet, please smash that like button down below. Subscribe to the channel so you'll be notified anytime we drop new videos or we're going live. So with that, I hope you guys have a great evening, and we'll see you later. Take care.